Welcome back, guys. We're going to get into market analysis once again. This is for this past week that's happened so far, as well as predictions as for what the next week's going to happen and everything. It's kind of neutral, my stance, but we're going to go ahead and run through a whole bunch of different shit real quick. First of all, we're going to look at the indices, look what the SPY and the QQQ are doing right now. As you can see, I kind of have this inverse head and shoulders kind of setup going on right now. It's kind of what I'm watching. This level does break, I'd expect this next 435 level in order to hold up, and if it does, regardless whether it is now or whether it is this level or even whether it is this level, I still see an inverse head and shoulder that be forming. I'm not hopping any longs or doing anything else at the moment. I want a little bit more confirmation before I actually get into anything, such as this little pullback that we're having. Make sure it's a flag rather than a downtrend, or it itself be a bearish flag, or a trap, that is, excuse me. We're also going to go ahead and look at some of the indicators that are going on right now. So far, this 443 level has been holding a support as it has in the past. Again, the next level to watch if that was to break is the 435 level, in my opinion. 440 could kind of act as a support as well as it has in the past. Psychological level, but in my opinion, the 435 is stronger. Another thing we're looking at is the EMAs. What are the EMAs currently doing? We're going to remove these drawings so that we can be a little bit more clear to what I'm talking about. EMAs, they're all stacked up on each other right now, all acting support right now at the moment. So nothing really much there. Again, this 400 level would be a nice drop too, because we also got the 200-day moving average right there. And if we were looking to look at the weekly time frame, you know, we have the 20 right underneath us as well at 446. So we're kind of looking good. Again, the 435 level would coincide with the 50-week moving average. So that'd be pretty dope. We do pull down to that level right there. Let's go ahead and hide those real quick. Next thing we'll know, we're going to look at the anchored VWAP, something that I used and explained in previous videos. Basically measures deviations, letting us know whether we're overextended or we're currently where we need to be at. So this one's anchored. You're supposed to, when you do use the anchored VWAP, you're supposed to anchor it to high points as well as low points. The lowest point we've experienced this year has been on February 24th, whenever Russia declared war on Ukraine. And currently right now this indicator is telling us that we are overextended, and the mean or the pullback area would be this 436. So once again, my opinion, that 435-ish level, 436-ish level would be nice to be able to get this pullback to, but there is a chance that we continue to move up higher, as I'll show you with the next anchored VWAP. I anchored this one to the high point of the year, which was January 4th of this year, and we were extended after a while after this large move after the FOMC minutes. However, we have pulled back to the mean. Usually what happens is once it hits the mean, it'll go back in the other direction if it is in a downtrend. And now that we're on the opposite side, if we were to continue this uptrend, this would be a nice bounce area for it as well. So the 441, 442-ish, I mean the 442, 443-ish level right here would be the neutral zone, or a point of bouncing, in my opinion. On this one and the other one, it would be the 436-ish level, 435-ish level. So once again, those are two areas that I'm watching for. Maybe not this week that we'll drop down to that level. Maybe we even get some more consolidation or whatever, but those are definitely some key levels to watch in my opinion. Let's go ahead and look at some other indicators as well. So I'm going to take some of these off the screen. I'm going to leave the rest of those up because they take a little bit in order to try and configure. Another one we're looking at is Evan Cabral strategy. This is a Bollinger Bands basically that we're looking at, as well as the 200-day moving average. And basically, whenever they contract, a move is to be expected, and whenever it expands, it's letting us know the move is happening. So right now, we were contracting at some point in time, and back here, you know, we didn't really get too much contraction. The contraction was right here, and we expanded over time, leading us to this big ass move right here. We got a sell signal, and currently we're experiencing a buy signal on this indicator itself. We're somewhere in the neutral zone to the mean. Again, when we come back down, bounce off of that level, it's a possibility that we continue to the upside. Definitely something to look at. This isn't necessarily telling me too much, just because I don't play off these signals, which they actually have been pretty accurate, if we're being honest. But I play it more of the statistical reasons of why we should go down. So like right here, we're hitting the second deviation, should go down based off of that fact. But right now we're kind of in the neutral zone. Again, getting a neutral reading in my opinion. Next one we're going to look at is the relative strength index, RSI. Technically it has a neutral reading at the moment. However, this is a moving average it has, and usually whenever it's above it, it is a bullish move, or we're in the midst of a bullish move, and when we're below it, we're in the midst of a bearish move. We're currently below it, and currently the moving average is curling down but that is to be understood. I mean, understandable, because we have had this little slight pullback. So if we were still bullish, we could see this potentially go back to the upside, kind of like how right here we kind of had these false signals of trying to go up, but at the end of the day we ended up falling. Alrighty guys, let's go ahead and look at the next indicator that we have going on that we're going to be using, which is the volume profile. The volume profile lets us know what areas, at what levels has the most shares been traded, and usually these coincide with good levels of support and resistance. And currently, looking at this chart, there's hella resistance to the downside. There is some to the upside, don't get me wrong, but there's a lot less resistance in this area than there is trying to fight your way through the VPOC and fall further down. So that's something to keep in mind. This one's lean more bullish on this one. This is a hard level in order to get through, which is going to be this 450-ish level. But once we're above that, there's not too much resistance up ahead, at least until we start getting to this area right here, around this 465-ish area. So it's something to look out for if we were to go to the upside. And I think that'll conclude all the indicators that I did want to look at. Alrighty, so we could go ahead and do the same for the QQQ. It's basically the same thing. We have this flag or pennant, whatever you want to call it, but however, we do have a gap to fill on this. So that's the upside. I think the statistic is like 92% of gaps get filled within in total ever. 70% of them get filled within a few days, and the other ones get filled in through the rest of the time of history. So we'll see if we do end up filling that here this week, or if we continue to fall. And once again, like I said, hit these lower levels that we reached previously over there, and would it be a nice area in order to bounce? Maybe not. We will see. Indicators basically say the same thing as well. We're about to hit our mean, getting close to it, whether it be on this time frame. With this anchored spot, or would it be the other anchored spot? We're actually below hitting the negative deviations at the moment on the QQQ. But the QQQ is affected a lot more in downward moves than the SPY, but we also have greater upward moves than the SPY, as the inverse is basically true as well. So definitely something to keep in mind. Again, the other indicators are kind of saying the same thing. So some of them might say have like a bullish reason to be in the markets. Other ones kind of neutral, or they'd lean more bullish than bearish. Also want to look at the strength of the US dollar. This is a horrible pennant I drew over this span of time. Basically, the dollar's been in a crazy uptrend. Kind of had a cool off phase these past couple of weeks, but last 2 weeks we had a nice move to the upside. Or actually, this past week, excuse me, we had a nice move to the upside. So it's definitely something to look at. What's called where we're going to go the rest of the week. Who knows? But since the exchanges are open again, I'm currently in the midst of the move. So it'd be definitely interesting to see where we go within the dollar. Are we going to break through this trend line, possibly even come into the resistance for this past area that has acted in the past, whether it be in the 2020 or 2016. What exactly is going to occur? We have no clue. But whenever the dollar is up, normally stocks, commodities, everything is usually going down, because the value of your buying power goes up, making stuff that you buy worth less in comparison to the dollar. And this is a US dollar against other currencies, just to let you know what this index is. So if this does end up hitting resistance and we end up falling down, that definitely could be bullish for us, as it has worked in the past, whether it be with crypto, whether it be with stocks, whether it be with multiple different things. So it's definitely something to look at. Another indicator or a chart I wanted to look at was this. Again, I mainly trade the QQQ just because I like the volatility of it. I don't do options as much anymore, but I do shares. So it allows me to make more money than just playing like regular SPY shares. But long-term swing-wise, this is honestly a good buying point. This is the indicator basically letting us know, or not even indicator, it's a chart itself. It lets us know how many of the U.S. stocks within the NASDAQ are above or below their 200-day moving average. Right now, this chart specifically is letting us know how many are above their 200-day moving average. So out of the 100 stocks, only 32 are above their moving average, the 200-day moving average. And basically, normally whenever we hit these zones, which is below 30, it's a nice buying opportunity in the long run, as it's marked some of the crazy bottoms that we had in the past. So like the pandemic drop, in 2018, when we had an end of our bull run, whether it be in crypto or whether it be in the stocks as well. 2016, the housing crash, 2008. Just a whole bunch of different things have marked bottoms here, and this is honestly one of the bottoms we had. We had worse readings in the past, but we're getting pretty close to the range again. So if you're looking for some long-term positions, it wouldn't be a bad spot to do this. So even if you do have further volatility to the downside, it'd be even better buying opportunity if you are DCAing into the market. Another thing you can keep in mind on this is the Fed minutes meeting they had this past week. They basically let us know that 50 basis point rate hike is definitely in the books, which we already been knowing, and the market's kind of already priced in that there is going to be a 50% rate hike. The Fed normally would have done it the first rate hike, but they said due to unfortunate geopolitical circumstances, they didn't. So that's definitely getting us know that they're prepared to, they need to, and they're willing to do what's needed in order to bring inflation down. Not only that, but they're having more of a speedy rundown than expected. The market was kind of pricing in, or at least some analysts had spoke about, 60 to 70 billion dollars runoff on each month, and right now the Fed spoke on 80 to 100 billion dollar runoff per month on their balance sheet. This is mortgage-backed securities, this is treasury bonds, this is a whole bunch of different stuff they have been purchasing in order to put liquidity into the markets since COVID to help us out. And they just recently stopped buying in March, I believe it was, and now they're going to start selling it in May. Something else to keep in mind is the yield curve. A lot of people have spoke about it this past week as well as the week before that, and letting us know that it has inverted. The 10-year minus the 2-year yield has hinted at recessions in the past. It's marked 10 out of 11 past 11 recessions. The false signal once was sent in 1960 something. I forgot what year it was exactly, but that was a false signal. But it has predicted the past 10 recessions though. So it's definitely something to look at, because it did actually hint at not necessarily COVID crash, but there was something already that was supposed to happen in 2020-ish, 2021, that was supposed to be bearish for the markets, in which we were going high and we're supposed to have fallen. The pandemic was just kind of an excuse for the markets in order to fall, in my opinion. Now it's inverted again. It was a softer inversion. It was only for like a week or a few days out of the week. So it's definitely something to keep an eye out for, to see if it does have consistent time being inverted. And basically whenever the 2-year, the 10-year minus the 2-year yield, what that means whenever it's negative or below zero, is basically that the market's pricing in more uncertainty, more risk to come within the 2 years than there is in the 10-year time frame. So that's why they're paying out more for 2 years rather than 10 years. Not only that, but banks normally borrow money at the 2-year rate and lend out money at the 10-year rate. So they're technically losing if the yields were to be inverted. Something else to pay attention to is that's definitely scary at the moment is rotation. For those who do believe in market cycle theory as well as economic theory, basically people rotate their money within the SPY. Basically, there's 11 sectors that make up the SPY. Whether it be, as you can see on the chart, there's healthcare, consumer staples, I believe is the defensive, utilities, energy. Consumer cyclical is, if I'm not mistaken, it's stuff like wants, and consumer defensive is needs. So something else, this is kind of what I'm talking about right now, this market cycle theory. And basically what happens is basically we peak out. When we peak out in the market, that comes before we peak out economically wise, but the economy is what drives the market, which is kind of counterintuitive, but it's that's technically how it works. And normally once we peak out, that's whenever energy is going to be the best buying opportunity. And as we've seen in the past, we can look at the energy chart, which is XLE. When we peaked out around the December, January time, that was the best time to buy energy. I mean, this is technically not necessarily invalidated, but this is definitely being influenced by the Russia-Ukraine situation. So technically, you could go against this being one of them. But the truth of the matter is that December, January time was the best buying opportunity for XLE, and it's been performing since then. And it's actually breaking out at the moment for another leg up. And then where is it at? Another sectors that people need to watch. Oh yeah, I already had it highlighted. Damn, I'm over here fucking up. God damn it. is consumer staples, healthcare, and utilities would be the next part. And this is mid recession, market wise, and this is getting close to the economic top. So if we look back on over here, let's see how XLU has been performing. Actually, we can even look at the chart that I had pulled up before. So we see past 3 months, what are the top 4 names? Energy is one of them, obviously the best performer because it started sooner. Utilities, basic materials, and healthcare. Past month, what has been performing the best? Healthcare, consumer defensive, which is consumer staples, utilities, and energy. And what does that hint at us? Energy used to be the top performer. Now it's kind of lagging behind. It's still gaining. Don't worry. Consumer staples is getting a big name for itself. Healthcare is getting a big name for itself. And utilities is getting a big name for itself. So it's definitely something to watch, because if this is true and we are currently experiencing rotation of money within the sector of the SPY, that's not looking good, because that usually leads to a harder drop in a bear market or the recession. So something to keep in mind. Again, I'm not trying to spread fear. I'm just letting people know, like, this is theory that's been studied before. It's followed it before. So it's definitely something to watch out for. Also, I want to talk about seasonality. Seasonality is important. Maybe not to you. Maybe some people care, some people don't care. So if we're strictly speaking statistical probabilities, the past 20 years is what I'm about to show you on this chart. So if we go back to seasonality, what's the best performing month out of the whole year in the past 20 years? For the past 20 years, it's April. We've averaged 2.4% gain each year, basically. The worst drawdown was -6%. The best return was 13%. And if we look at the SPY right now, where are we at currently? How much are we up or down for the month? And if we look at the beginning of what was April 1st, the close, or we look at, I guess we could look at the open, and we bring it down to the close, we're currently at -1%. And from our lowest point, we were down almost -2%. So what's -6% equate to? So if we were to repeat the worst possible move we could get in the history of the SPY for the past 20 years is 6%. That brings us down to $426. Don't get me wrong, that move is definitely scary and definitely frightening. However, that's the worst drawdown we've ever had. Statistically speaking, out of 20 years, that's what, 5% chance of this happening, technically. That's kind of improbable. We're more than likely going to get an upwards move of 2% on average. So what does 2% equate to? 2% move would put us about how high we were, 462-ish level. The best gain was 12%. So if we go from the open and we go up 12%, or have a possibility of going all the way up to 500 something, creating new all-time highs. So that's definitely something to watch. We're going to see if seasonality does play a big role in what's about to happen. Something else to keep in mind is earnings. Earnings reports for banks. Normally banks, when they report their earnings, they lead everything else in this cycle of earnings. They're the first ones, and they're going to definitely let us know what direction the market's going to be going in. If they have good earnings, great for the market. If they have bad earnings, then not so great for the markets, especially since financials is a big part of the SPY. Something else to look at for possible plays is this divergence that's occurring in silver and also gold, as well as the miners of metals, whether it be GDX or whether it be some other ETF that you're looking at of miners. Currently, they're going up. And what's happening to the silver and other metals as well, they're taking a little break after this crazy move to the upside. So this is definitely a possible play that people could get into if you're looking to play probably short-term type gains, swing here hopefully in the next week or two. That's definitely something to watch. Something else to watch in relation to the Fed and the FOMC is what has the PMI done, which is price. I don't remember the acronym stands for, but basically whenever it's high, it's good for businesses. It allows things to flow more smoothly. It's growth, basically. And once we are at the bottom, that marks slow movement, not much growth within the business realm. And how does that equate to basically the federal fund rate. You know, whenever businesses start doing poorly, what government will do, the Fed more specifically, they'll lower interest rates, allowing business to flourish a little bit more. Usually, whenever they're at not historical lows, but historical lows, basically, the market starts getting stimulated again, and as a result. And what they do is they try to slow things down so that way they can calm down the markets because the markets are too hot, and this and that, so much and so forth. However, currently, we're at zero basically, and we're already having a fall in the PMI. So what is the Fed gonna do? What are the Fed's options in order to cool down the markets? I mean, in order to stimulate the markets, because obviously they're falling now. It's definitely something to watch and definitely something to be concerned about. Another thing that you need to be watching and looking for is the inflation rate. Inflation has been peaking out. Each time inflation has peaked out, it matched up with the year later difference from the PMI. In this video Game of Trades put out, he shows basically how that happened each time. You know, in 1970 it happened in March of 1970. 1970 PMI peaked out at 1969, March 1969. And currently the PMI peaked out in May of 2021. So will we see a peak of inflation in May of 2022? Maybe, maybe not. But if we do, that's definitely going to be bullish for the markets. And it will definitely get us excited because people are like, okay, the Fed is finally doing something successful and it's calming down the inflation that we're currently experiencing. I feel like a big part of that as well is what Biden's doing with oil, allowing us to tap into reserves as well as giving permits in order to start drilling more oil. Double check me on that last statement because I don't know if he did allow permits in order to continue drilling here in the United States. But it's definitely going to drive prices of oil as well as energy down, allowing energy to cool off. Not only that, but it's also going to help our inflation because our inflation is heavily driven through the geopolitical reason. I think geopolitical stances of Ukraine and Russia. Another thing to look at, this is analyst Benjamin Cowan, and what he uses his indicator is the bull market support band, or the bear market support band. It just depends on where Bitcoin is at the moment. And normally, whenever we get a weekly close below this, we ended up falling down. And if we do get a weekly close above, usually we start going up. However, what he stated before, everyone starts floating their boat because of this crazy rally that we had recently. He was looking for a weekly close above. Not only that, but for it to retest and hold its support. And currently, we had a weekly close that fell back below the band, unfortunately. So, are we going to continue down or are we going to come up? Statistically speaking, normally whenever it does close below, in most cases it does continue down. However, there has been 2 cases, I think he points out, or 1 case, in which it closed below, but then the next week right after it went up. So it's definitely something to look out for, just because Bitcoin does technically usually follow the QQQ or even the SPX or whatever the market's normally doing. It's also doing the same as well. Another thing that I want to be able to talk about, from this point on, it's going to be mainly news that's not necessarily so pertinent to the markets, but rather just stuff to look out for. Another one is the AMD downgrade. Basically, what happens every quarter, or every 3 months, I won't say quarter. Every 3 months, banks give their analyst ratings or their price targets for different companies. And currently, AMD got a price cut. They were expected to be at 148, and they got cut down to 115. Why? Because cyclical reasons, supply constraints, as well as market slowdown. So it doesn't change anything about the fundamentals of the company. So if you're bullish on AMD long term, this provides a good buying opportunity. But if you are swinging a trade and you saw it die horribly, as I'll pull up right now, that was one of the main reasons why. We had a pullback in the market, don't get me wrong. But look at this gap down. That's the gap down of overnight news because of this downgrade. Not only that, but just the continued selling since the market was weak. And this was a weak name. And it also not only affected them, but also affected semiconductors in general, whether it be NVIDIA, TSM, or even other semiconductor names. Next thing I want to talk about was Elon Musk getting stake in Twitter. Now this is crazy because the markets went bananas over this shit. The stock launched up crazily. We're going to take a look at what exactly it looked like. We had this crazy move up. Look at this. Look how much candlesticks normally move, and look how much they move the past couple days. All right, so we'll go ahead and mark it from the close of that day all the way to the high. It reached a 38% move in shares. So if you're playing options, oh my god, you done made hella money or you lost hella money. One or the other. But you know, it's buy the rumors, sell the news type deal. So if you would have gotten a pre-market, you could have rode this wave up, and you probably would have sold sometime in here. Because what's going to end up happening? We're end up getting a continued drawback in order to fill this gap, which is a 13-14% drop. I'm not saying go short the damn stock, but sheesh, that's crazy news. I mean, that's crazy movement based off of news. And honestly, Elon Musk is kind of known for this wanting to be influential in markets, as he used to be hella circling around Dogecoin. You know, and there was a SNL skit that he was a part of. Let me go ahead and find it on Kraken first. I had this marked up. On Kraken, you know, what did people see? They saw Dogecoin was getting hella attention from Elon. They bought in. They rode it all the way up to Saturday Night Live whenever it aired. And guess what happened? It shit itself. And it was down almost 85% at one point in time. You know, and it's one, the risks of altcoins because they fall harder than Bitcoin. But not only that, but something that doesn't even have utility, a meme coin. And it literally died. So it's definitely bearish for that. And, you know, it's the buy the rumor, sell the news type deal. So that's something to look out for and always something to remember. Let's see, what is next? Next thing I want to talk about is this forced stimulus check that California is trying to get into. You know, I was in a lecture and one of the guys mentioned this, and it's just retarded. Excuse my language, but it's just dumb why they would want to be able to do this. So just think about this. All right, so supply constraints is the reason why inflation is so persistent, especially why commodities such as oil and the XLE have been taken off. So by giving money to the market and putting money into the market, into the hands of the consumer, is not going to help drive the prices down. It's going to help drive the prices up. And what happens whenever you use the $400? What happens after that? The prices are still going to be up, and you just basically fucked yourself. But I don't know if there was elections going on right now, but usually politicians try to provide a good name, especially whenever the end of their term is coming up. I don't know if it is going on, but if it is, this is definitely driven by that, possibly, in my opinion. So it's something super dumb that California's about to do. That's probably why most of them moved to Texas. What is the next one? Next thing I want to talk about is Elon Musk and Jack Dorsey mining Bitcoin. If you're bullish on Bitcoin, it'd probably be a good idea and bullish on Square or bullish on Tesla, you might as well go ahead and get stake in Tesla as well, or stake in Tesla and Square as well, because it's definitely going to help out. You know, that's crazy, and they're trying to do this with renewable energy, with solar energy, that is, and that's something that Elon Musk was super bullish on. He wants to be able to convert, you know, these proof of work systems, and put them on renewable energy rather than them using regular energy, just because it's more cleaner and it's more safer for the environment. And that's why he stopped accepting Bitcoin, and that's why partly the reason why we had a summer lull in the markets, because of that reason. And there was big fuss over that, and now he's trying to do something himself in order to help that out. So it's definitely bullish for crypto, and it's definitely bullish for Tesla and Square. So it's something to keep in mind if you're a long-term investor, that is. All right, the rest of these three are, I wouldn't say mid news, but mid news. China is increasing their nuclear arsenal. They feel like there's a threat because of the United States. And what's crazy about that is that China actually spreads propaganda in their country. I was listening to a podcast of Jocko Willink, and basically he was describing what's going on. What's some of the things they do. Apparently there's films in China that represent the United States as enemy, and not enemies, what's the right word? As bad people. Not only that, but we're controlling. You know, we're trying to take over the world. We're the bad guys, and I'm not gonna say they're wrong, but they're mid. They're mid in their statement. You know, the United States isn't that. They got some blood on their hands, basically, but they're showing us as if like we're the enemy, we're the bad people. We're trying to take over. We're trying to make everyone suffer under the rule of the United States. And they're feeding that to the people. They're making the people think that. So whenever they're increasing their arsenal, it doesn't look that bad in the people's eyes, because they're like, oh snap, China's standing up. You know, we're standing up to the big guy. And I think we're both at fault, but that's definitely dangerous, especially with the tensions of Russia, and since Russia's also communist. Putin has discussed Ukraine peace talks with Russian Security Council. Man, I don't know about that. There's been plenty of talks about peace talks, and quite frankly, each time there ends up being something, and they end up shit talking about each other. So like, I really don't. I know that I don't trust that news, but it's kind of like, we heard it so many times, and we've seen it fail so many times. So like, what makes this time different? It's kind of like that bad relationship. You keep getting back with your ex. You're like, what makes this time different? I haven't gone through that, but I've seen and I've heard things. Lord. The last one I want to talk about is German president calls for war crimes trial against Putin and Lavrov Spiel. I think that's how you say his name. That's definitely bad for tensions with the West, as well as whether it be West Europe or whether it be the west side of the world versus the east side of the world. That puts extra tensions, and it puts extra conditions in the peace talks. Russia definitely wants Ukraine to stay out of NATO, but not only that, but now they're getting what's called war criminals by Germany, by the U.S., by Biden. It's just not making any of these tensions any better. So it's definitely kind of a scary topic. And yeah, to conclude this episode of the market analysis, there's a whole bunch of shit that's going on in the markets. Overall, I'm gonna talk about my strategy and what I plan to do with my money and with my account here in another video. But I'm in a position where if the market goes down, I got cash to buy the dip. If the market goes up, I got exposure to where I'm good, And my ideal thing would be that the yield inversion is true. We're gonna get a recession, but this isn't a lagging. Not a lagging ender. This is a pre. I don't even know what you call it. Basically, this happens before the inversion before the recession actually happens. So we will get another leg up in my theory of what I want to happen, but the market doesn't ever do what you want to happen. It does what it wants to do. This inverse head and shoulder plays out, come down, provides another better buying opportunity. From there, we start going up, hit all-time highs. Eventually, we hit our high, and eventually come to the point where everybody starts to come in. Because one of the things that I feel like will fuel this is the Fed. The Fed has talked about whole bunch of different things that they plan on doing, running off the balance sheet, raising interest rates, but they always overpromise and underdeliver. So the underdelivery of all that is definitely going to boost the markets. We're going to be bullish. I think everybody's going to be like, oh yeah, that was nothing. We got over this and that. Because if you look in the past of what happened, let's say with the housing crash. Where is it at? Where you at, bastard? We had this crazy bull run. After that, we had this massive dip. Everybody's like, oh no, recession. Boom, we had crazy gains. What eventually happened? Fell off a fucking cliff. What happened in the dot-com bubble? We had this crazy bull run. It had this dip. Oh no, everything's over. Then we had this massive ass run. So I feel like it's kind of the same exact thing in my opinion. We had this crazy bull run. We finally broke this upper trend. We had this almost 20% correction on the QQQ. I think it's like a 15% correction on the SPY. Everybody's like, oh no, it's the end of the world. Recession's here. Boom. We're going to hit this trend. And from there, we're just going to end up falling off a fucking cliff later on down the road. I forgot who it was. It was whoever was the founder of Fidelity Investments. He said that in the past, I think it was 50 years or something like that, 50 trading years, every 2 years there's a 10% or 10 to 20% correction, and every 5 years there's a crash. That's normally what happens. We currently experienced a correction, which was 2 years after the crash of COVID. What was this? Yeah, it was a crash. I'll call it a crash. 35%. We're going to get our leg up, and then we're going to end up having our crash, in my opinion, because when was the last crash? That was 2008. So, I don't know. There's a whole bunch of speculation. It's a whole bunch of me wanting and hoping, but that's basically what my plan is. I'm prepared for us to continue to fall and the recession to hit now, or some type of horrible event to happen to where the market just fucking dies. with cash reserves, and I'm exposed. So if we go to the upside, we're good. I'll be able to sell up here and hopefully be able to catch a good buying opportunity if we were to fall off the face of the cliff. So that's going to conclude my analysis for tonight, guys. Appreciate you for all the support. Definitely like this video if you did learn something, or if you like what I've talked about here on the channel. Comment if you have any suggestions, whether it be what I talk about, maybe things that'll be able to help with attention spans and like retention and stuff like that. And just subscribe if you want to be able to see some more, or see some more podcast episodes. We're going to be posting one here soon as well.